Welcome to Tech Money Madness, your daily U.S. stock market podcast. April 21, 2026. We're doing a real deep dive today because if you look at a seismograph, you're usually just watching a million little tremors.
Right, yeah. Just a lot of background noise.
Exactly. And the stock market is typically exactly like that. It's noisy, it's chaotic, pulling in like 100 different directions at once. But looking at the daily market briefing for today, there's just this one massive primary wave on the financial seismograph.
Yeah, crude oil hitting $90 a barrel.
Right. And that single spike is basically fracturing everything. I mean, from airline balance sheets to Silicon Valley leadership to Middle Eastern diplomacy.
It really is. The tape today was actually fascinating because major indices were fighting tooth and nail to edge higher throughout the entire session.
Yeah, they were trying.
They really were. There was genuine buying pressure early on, but that $90 anchor just dragged them down. The S&P 500 ultimately slipped by 0.3%.
We just couldn't outrun it.
No, it couldn't outrun the physical reality of the energy markets. $90 a barrel is a massive psychological and economic threshold for investors.
And the causality here is, it's completely direct. We aren't looking at some abstract algorithmic trading glitch today.
No, not at all.
We are looking at a physical supply reality driven by the ongoing conflict in Iran. You introduced geopolitical tension into a region that is so foundational to global energy, and, well, the risk premium on oil just shoots up instantly.
Right, and the ripple effects of that physical reality are tearing through corporate balance sheets today. It's separating the market into stark winners and losers.
Based entirely on their exposure to input costs, right?
Exactly. Energy stocks led the broader market gains today, which is the immediate logical reaction. But the collateral damage is where the structural vulnerabilities of the market really get exposed.
Yeah, because oil prices are basically like gravity in the stock market.
That's a great way to put it.
When they spike, anything heavy and fuel-dependent just immediately gets pulled down. And United Airlines is the absolute prime example of that gravity today.
Oh, absolutely.
They reported their first quarter earnings, and by all traditional metrics, they had a phenomenal Q1. They topped Wall Street's expectations. Planes were full, operations were humming.
Yeah, a textbook great quarter.
Right, but the stock still got hammered because they turned around and completely slashed their entire forecast for 2026.
Because a great Q1 earnings report means absolutely nothing if the macroeconomic environment shifts under your feet. Airlines run on jet fuel. It is one of their single largest operational expenses.
And their profit margins are notoriously razor-thin to begin with.
Exactly. So when crude surges to $90, the cost of jet fuel surges right along with it. United is looking at the reality of a looming jet fuel shortage and skyrocketing costs.
So they're essentially telling investors that they just can't outmanage this kind of inflation on their primary input.
Right. And it's a brutal squeeze for the consumer, too. United's margins getting squeezed by fuel means that cost is eventually passed down to the ticket buyer, or they just start cutting regional routes entirely.
Yeah, you're either paying more or flying less, but the gravity of $90 oil is pulling down sectors you wouldn't initially expect to.
Like the gold miners.
Yes. Gold miners took a massive beating today. An ETF like GDX was down 4.1%. And I want to pause on that for a second because usually, when there's geopolitical tension in the Middle East, gold is the ultimate safe haven.
It's the classic fear trade.
Right. The fear trade should be sending gold miners to the moon right now. So what happened?
Well, you have to look at the other macroeconomic forces overpowering that traditional fear trade. The miners are underperforming today because of rising treasury yields and a significantly stronger U.S. dollar.
Okay, break that down for us.
Sure. So when bond yields go up, investors can get a guaranteed risk-free return on government debt. Gold, as a physical asset, doesn't pay a yield. It just sits in a vault.
So the opportunity cost of holding gold goes up.
Drastically. If the 10-year Treasury is paying out a high yield and the dollar is strengthening against foreign currencies, large institutional money rotates out of zero-yield assets like gold and into dollars and bonds.
So the fear surrounding the Iran conflict is definitely real. But today, the sheer gravity of the strong dollar and bond yields completely overpowered the geopolitical flight to safety.
Exactly. The market is ruthlessly logical like that.
It really is. And While heavy, capital-intensive businesses like airlines and mining are buckling under these rising costs, there's a sector that is surprisingly thriving despite incredibly high operating expenses.
Healthcare.
Healthcare. We saw UnitedHealth Group, UNH, jump a massive 8% today. They were literally one of the top gainers in the entire market.
Which is wild on a day like today.
It is. They topped their quarterly estimates, and unlike United Airlines, UNH actually raised their profit outlook to over $18.25 per adjusted share for 2026.
And the briefing specifically attributes that to UNH managing high medical costs effectively.
How are they managing it so much better than anyone else?
Well, UnitedHealth has built this ecosystem, spanning insurance, pharmacy benefits, and direct care provision that can just absorb inflation and higher medical utilization better than almost any other entity on Earth.
They just have the sheer scale.
Right. They have the data and the scale to optimize traditional healthcare margins in a way smaller players can't.
But those massive margins and that scale are exactly what's attracting the biggest disruptors in the world. I mean, the briefing notes that Amazon has officially launched a new GLP-1 weight loss program.
Promising fast, convenient access.
Yeah. And GLP-1s, the class of drugs like Ozempic and Wegovy are arguably the most highly demanded pharmaceuticals on the planet right now.
Oh, without a doubt. And look at how Amazon is approaching this. They don't view healthcare as a traditional medical practice with waiting rooms and clipboards.
Right.
They view it as a logistical and data problem that technology can solve.
I do have to push back on Amazon's strategy a bit, though. Are they spreading themselves incredibly thin here?
How so?
Well, they're pushing massive capital into artificial intelligence. They're expanding their partnership with the AI startup Anthropic. They run AWS, they run global shipping logistics, and now they want to be the world's pharmacist for weight loss drugs.
It sounds disjointed when you list it out like that.
It does.
What?
Connecting those dots feels like a stretch to me.
But think about the actual mechanics of a GLP-1 drug protocol. It requires an initial consultation, a prescription, rigorous ongoing patient monitoring, and dealing with incredibly complex insurance prior authorization.
Which is always a total nightmare.
Exactly. And on top of that, it requires consistent cold chain monthly delivery.
Oh, I see. That is a recurring consumer subscription model.
It's a holy grail of recurring revenue. Amazon is obsessed with sticky recurring subscriptions. They are taking their logistical mastery, the infrastructure that gets a package to your door in 2 hours, and applying it to a high-demand medical treatment.
Okay, that makes sense. But where does the AI fit in?
The AI partnership with Anthropic you mentioned is the invisible engine here. They are likely using advanced AI models to automate the headache of insurance approvals, predict regional inventory needs for the cold storage of these drugs, and manage the low-level patient data monitoring.
Wow. So while UNH is optimizing the complex, messy reality of traditional insurance and medical networks, Amazon is basically building a streamlined, AI-powered pipeline to deliver the most popular drug in the world right to your doorstep.
Exactly. They want to be the invisible infrastructure for your health, just like AWS is the invisible infrastructure for the internet.
That's fascinating.
And Amazon's realization that AI is the ultimate logistical tool isn't happening in a vacuum. It is triggering a survival response across all of big tech right now.
The era of resting on your laurels is over.
It really is. And it's forcing massive leadership changes at companies that defined the last decade.
Which brings us perfectly to the bombshell from Apple today.
Yeah, this is huge.
Tim Cook is officially stepping down as CEO this September. He's transitioning to executive chairman and passing the baton to John Ternus. And the briefing is extremely clear about Ternus's primary mandate.
Fixing Apple's AI strategy.
Exactly. His defining challenge is artificial intelligence.
This is a seismic regime change for Silicon Valley. I mean, Tim Cook's tenure has been defined by unparalleled operational and supply chain mastery.
He built the most profitable, perfectly tuned hardware manufacturing machine in human history. Cook figured out how to build and ship hundreds of millions of physical iPhones around the globe without a hitch.
But the defining challenge of 2026 isn't manufacturing the glass and aluminum anymore.
Right. It's making the device actually smart. The AI race is moving at light speed, and Apple has been visibly lagging behind Microsoft, Google, and Amazon's Anthropic partnership.
They've been quiet for too long.
So my question is, John Ternus has historically been a hardware engineering guy, right?
He has, yeah.
Is replacing a supply chain genius with a hardware genius really enough to win a war that is fundamentally about artificial intelligence software and massive compute clusters?
Well, Apple is realizing that their pristine hardware ecosystem is just an empty vessel if the intelligence powering it falls behind.
Yeah.
Putting Turnus in charge signals a recognition that the physical hardware and the AI software can no longer be developed in silos.
They have to be integrated from the ground up.
Exactly. The silicon chips inside the phone have to be custom built from the atomic level up to process AI locally on the device. Turnus's job isn't just to write code, it's to redesign the entire physical architecture of Apple's products.
To act as the ultimate delivery mechanism for artificial intelligence.
Right, it's an adapt or die moment, even for a company worth trillions.
And they aren't the only ones realizing that the playbooks from the 2010s are dead. Microsoft made a massive move today, too.
The Xbox announcement.
Yeah. The new Xbox CEO just announced they are cutting Game Pass subscription prices and promising to, quote, recommit to gamers.
That is a stunning reversal for a modern tech subscription service.
It really is. Game Pass was modeled to be the Netflix of video games, right? A service where the strategy historically dictates that prices only ever go up once the consumer is locked in.
Exactly. Slashing prices shows an acknowledgement that consumer trust is fracturing and discretionary spending is getting really tight.
Between Apple swapping CEOs to fix their AI gap and Microsoft slashing prices to stop a subscriber bleed, the tech titans are suddenly playing defense.
Because the macroeconomic groundwork supporting these massive companies is shifting just as fast as the technology itself. The global capital that Apple, Amazon, and Microsoft rely on to function is undergoing its own regime change in Washington right now.
Yeah, let's pivot to Washington because the briefing details a major move by the Trump administration today. They are actively discussing establishing a currency swap line with the United Arab Emirates.
This is a really crucial piece of the puzzle.
Now, obviously, we aren't taking any political sides here. We're just reporting on the market mechanics. The stated goal is to provide dollar liquidity to the UAE. To understand why this matters, you should think of a currency swap line as like an international financial safety net.
Right.
It's an agreement between two central banks to exchange currencies. It ensures that when global markets get stressed or seize up, our allies still have direct access to U.S. dollars.
Which allows them to keep trade flowing smoothly.
Exactly, without having to dump other assets or bonds in a panic just to get their hands on cash.
And this swap line with the UAE ties the entire day's market narrative together perfectly. It goes right back to what we talked about at the beginning, the $90 barrel of oil.
How so? Connect this for us.
The global oil trade is overwhelmingly priced and transacted in U.S. dollars. That's the petrodollar system. So by ensuring the UAE has robust access to dollar liquidity, the administration is essentially setting up a financial firewall.
Oh, I see. They are trying to ensure stability in a key oil-producing region precisely because the conflict in Iran is threatening the broader supply.
Exactly. They were using a central banking tool to leverage the gears of the physical energy market. The oil market needs the dollar to function, and the U.S. needs the Middle Eastern oil market to remain stable to prevent inflation from spiraling out of control domestically.
And speaking of controlling domestic inflation, the entity that manages the U.S. dollar is also staring down a massive overhaul.
The Fed.
Yep. Kevin Warsh, the nominee for Fed chairman, just emerged from a very tough congressional hearing. And the briefing specifically points out that despite the intense questioning, Warsh emerged with his central bank regime change overhaul plan completely intact.
And the fact that his plan survived the hearing without major structural concessions is a big part of what rattled the markets today.
Really? Why is that?
Because the Federal Reserve dictates the cost of capital for the entire world. For the last decade, the market has operated under the assumption of a Fed put.
The idea that the central bank will just step in with quantitative easing and rescue the markets at the first sign of a severe downturn.
Right, but Warsh's overhaul plan fundamentally attacks that premise. His well-documented stance advocates for a strict, rules-based monetary framework rather than the hyper-reactive, data-dependent maneuvering we've seen recently.
He wants to shrink the Fed's footprint.
Exactly. He wants to shrink their footprint in asset markets and strip away the assumption that the central bank is just always there to backstop equity valuations.
And markets absolutely hate uncertainty.
They hate it. And they hate losing their safety net even more.
Yeah. If a nominee is coming in promising to fundamentally alter how liquidity is deployed and how interest rates are forecasted, the market has to rapidly reprice the cost of money.
So when you combine an impending strict overhaul of the Federal Reserve with $90 oil and escalating geopolitical conflict, well, you had the exact formula for why the S&P 500 couldn't hold its gains today.
Investors are trying to solve an equation where every single variable is suddenly changing at once.
Let's look at how that uncertainty actually played out at the extremes of the market today, too.
Yeah, doing a rapid-fire tally of the day's biggest outliers paints a very clear picture of these shifting variables. On the positive side, VMI, that's Valmont Industries, exploded up 12.6%,
Huge move.
and MLI Mueller Industries went up 8.53%. Now, these are companies dealing in agricultural infrastructure and industrial metals.
Hard assets.
Right. They are catching a massive bid as investors rotate into hard assets and physical commodities in response to inflation and the energy shock. We also saw UnitedHealth jump 8% as a defensive play, like we discussed earlier.
And the losers reflect the exact opposite side of that coin.
Tractor Supply Company, TSCO, plunged 10.8%.
Wow.
Yeah, they cater heavily to the rural consumer, which is a demographic that gets disproportionately crushed when gas prices spike at the pump. When it costs twice as much to fill up a truck, discretionary spending at a place like Tractor Supply just evaporates.
Makes total sense.
And GE dropped a heavy 6%, which directly correlates to our earlier point about United Airlines.
Because GE manufactures aerospace engines.
Exactly. If airlines are slashing their forecasts because of fuel costs, the companies supplying their equipment are going to take an immediate hit.
And if you look at the most active stocks by volume today, it reads like a perfect summary of the macro shifts we've unpacked. Apple, Amazon, Tesla, NVIDIA, and UnitedHealth.
The heavy hitters.
Right. The trading volume is heavily concentrated in the massive companies trying to navigate these tectonic shifts in AI, healthcare, and leadership.
You know, we spent a lot of time analyzing these macro trends, but it all comes down to how deeply intertwined these shifts are with your daily life.
They really are.
The geopolitical tension in Iran dictates the price of crude, which dictates what you pay to heat your home and what United Airlines charges you to fly to see your family. Amazon's push into GLP-1s, powered by AI logistics, is actively altering the landscape of your local pharmacy and how your healthcare data is managed. And the leadership shifts at Apple, combined with a total regime change at the Federal Reserve, fundamentally alter the trajectory of the tech stocks that likely make up the core of your 401k.
It's a cascading effect that starts with physical resources and ends up right in your portfolio.
It really does.
But witnessing how instantly oil prices reacted to the conflict in Iran leaves me with a rather provocative thought.
Oh, what's that?
Well, we saw the immediate ripple effect of a physical supply shock across the entire market today, right?
Yeah, $90 oil broke everything.
Right. But at the exact same time, we're watching companies like Apple undergo drastic CEO changes specifically to build AI infrastructure, and companies like Amazon embedding AI into our physical healthcare delivery.
Because artificial intelligence is quickly becoming the new baseline utility.
Exactly. So what happens when the next major market shock isn't caused by a conflict over physical resources like oil, but by a sudden disruption in our artificial intelligence infrastructure?
Oh, wow.
If AI is becoming the foundational utility for trillion-dollar companies, an AI supply shock, whether from a compute shortage, a massive cyber vulnerability, or an energy grid failure, could make $90 oil look like a minor tremor.
That entirely shifts the perspective. We spend all our time watching the geopolitical map for the next earthquake, but we might be ignoring the fault lines building up in the cloud.
Exactly. It all comes back to that seismograph. Today, the primary waves was oil and the Middle East. Tomorrow, the needle might swing wildly for a reason we are only just beginning to build the infrastructure for.
Something to keep a very close eye on. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.